Mom and pop shops may have hit a road bump. That, according to the latest survey by PayNet, which found lending to small businesses fell sharply in June. For more, I am joined by PayNet President Bill Phelan. Thanks for joining us.
Thanks for having me.
So this is a big turnaround from May, which was a much more optimistic report. What exactly happened?
Well, what this means is that we're going to have probably at least another quarter of slow growth. You know, the index took a dive last month, as you mentioned. And what we think businesses and banks should be doing is preparing now for this kind of extended slow growth type economy that we're going to see.
Does it suggest a broader slowdown than we thought we were in for?
Broader, it's all relative. Everybody's looking for the bottom now, right? And so we're all trying to figure that out. But we can see definitively with these leading economic indicators that it's slow. And what that means is that these small businesses, these are millions of small companies, they should start preparing themselves for it. They prepared in one sense, but in another, interest rates are low right now. There's a huge supply of capital. It's a great time to put some additional capital on the books and have it left over for a rainy day, if you will. And likewise, I think the banks are a little bit behind the eight ball right now in their preparations.
Let's talk a little bit about Europe. The argument had been that small businesses operating mostly in the U.S. were pretty much immune to the problems overseas, in Europe especially. Are we starting to see contagion in the ranks, or are the problems that we're seeing most recently still domestic?
It's everywhere, right? And these are global economies, and these small businesses supply international companies that sell to Europe. So everybody's affected, and it's not going away. So just pick your poison. Europe, unemployment, energy, volatility, commodities. You pick your poison. It's everywhere. And what we really need to do is prepare. And so we're telling clients and we're telling these small business owners that what they really should do is look now to extend credit, to take some capital on and be ready for that rainy day. This is a great opportunity. Interest rates are amazingly low rates right now, and there's a huge supply out there. And it's going to be harder to get capital when this slowdown does, in fact, become entrenched in the economy.
But that's easier said than done.
It certainly is. But what we see right now they're wonderfully prepared. They've got the strongest financials that we've seen in years. In 29 consecutive months, they've improved their ability to pay their loans on time. We see the arrears payments, the 90 days and the 30 days or more past due, at record lows right now. 30 days are at 1.11%. 90 days are at only 0.28%. That's 28 basis points. So these are amazingly low levels. And so their financials are in very good shape. So why not take a chance right now to put a little capital in the vault and be ready for a rainy day? And that's what we're talking about.
So that said, what sectors are responsible for this pullback that we are seeing?
Yeah, well, you know what? It's interesting. When we dive into the data, we see that the sectors that are really are projected to have a tougher time are really the retail sectors. These are the mom and pops, as you mentioned, the grocers, the eating and drinking establishments. They're really forecasted to see a real bump up in business failures over the next 12 months. I mean, in fact, we see about a 31% increase in business failures in that sector. Transportation, continually very volatile sector. It carries all the goods back and forth. When you get a slowdown, you get transportation hit hard. So that's also going to see some business failures above the national average. And this is the first time that we've seen the forecast for business failures actually increase since 2006. So it's really sending some signals to us.
So then there must be some pockets of strength out there too.
There absolutely are. We're all concerned about the drought. We're all concerned about the effect on the ag producer. And what we see is that the drought hasn't really hit the ag producers' financials yet in any kind of major way. They still, I think, have deep pockets. They've enjoyed a long run of building their balance sheets. And, those grain prices rose as the drought hit. So that kind of takes away the sting of some of the crop losses. And so what we see is, the ag guys are in pretty good shape still, even though the drought's going to hit them a little bit. It's really interesting. Construction segment is not going to be hit as hard either. I think what happened in the depression, was it took all the weak players out of the market, and now there's really strong construction companies left in there.
So I just want to circle back to lending. You've talked in the past about how small business lending is actually a leading indicator. Does the slowdown mean that we're in for more weakness in terms of GDP, the overall U.S. economy? And then, of course, what about hiring from there?
Well, that's exactly what I meant by we're going to have this extended slow growth period. The index that we're showing today is predicting what's going to happen in GDP 4 to 5 months from now. You know, back in January, we were talking about a low index and how it was going to mean a slowdown in the economy, and that came true. So we're still seeing that kind of environment. Very low index. In fact, it's at 98.6, which is lower than it was in 2005. So you've got this scenario where, you know, you've just got these very kind of tepid, weak economy right now, and that means we're going to have this continued weakness. And really, all bets are off if things get worse. If GDP falls below, you know, some long-term growth rate, then we're going to really have some troubles, and our stress tests show that.
All right. Thanks so much for joining us.
Thank you.
Our thanks to PayNet's Bill Phelan. I'm Bobby Rebell. This is Reuters.